Hello, so this is on types of loans and main providers for those loans. You have your mortgages. Mortgage loans are fixed payment loans secured by real estate. Unlike HELOCs, mortgages are used for purchasing a house, not for assessing locked in capital. They are distributed once at a time of purchase. The mortgage carries the largest balance of all loans for most people since the borrowed amount regularly reaches into the hundreds of thousands of dollars. The main providers of these are banks, credit unions, and mortgage companies. Thanks to the government initiative that encouraged home ownership, um, many non-bank mortgage companies exist to take advantage of government guarantees too. The Federal Housing Administration is especially helpful for first-time home buyers through their aptly named FHB program. Another type of loan is auto loans. The vehicle purchased using the loan secures the auto loan. The collateral implies lower interest rates than personal loans, but borrowers can only borrow enough to cover the cost of the vehicle and maybe some administrative expenses. The main providers of this are banks, credit unions, and non-bank companies, which may be applied to directly or through the dealership. Some large dealerships might even offer loans directly, meaning the loan remains in-house at the dealership, as opposed to being sold or transferred into a bank. Another type of loan is student loans. Student loans are unsecured loans specifically for education. These may be privately or public orientated. Since they are unsecured, the interest rate can be a little high, but government initiatives to educate the populace means some loans are government sourced, which typically results in lower interest rates. Generally speaking, for most borrowers, it makes sense to exhaust low interest government loans first, then make up any shortfall with private loans. However, federally determined interest rates are subject to change, so borrowers should consider the details of all loan options as pertaining to their individual situations before making any major decisions. So what are any main providers of this one? Federal and state government for publicly sourced loans, banks, credit unions, and private lenders. Restricted borrower loans. These are only available to some individuals based on their identity. Farmers, veterans, and first-time homebuyers are eligible for loans that require the borrower to be a farmer, veteran, or first-time homebuyer. Usually, the loan is the same as any other loan, but some benefits are affordable through industry or government agencies. These are usually just lenders for main providers, but government or industry entities might guarantee or support the loan. Then you have microloans. Microloans are a relatively new type of loan. Friends and family have granted these for millennia, but due to the democratization of finance through the internet, they are now more available widely. These are usually done by non-bank lenders and some credit unions. There's short-term loans, which payday lenders or pawn shops often provide short-term loans. These loans are required to be paid back quickly, and their principal amounts tend to be small. Some credit unions offer alternatives with similar loan structures, but much lower cost. Then you have insurance and retirement loans. Insurance and retirement loans are sourced from either your 401k or your life insurance policy. For tax-free retirement accounts, the loan is usually restricted to hardship circumstances. The main providers of this include your retirement account company for policy loans, loan companies that contract but to buy your policy or to become a beneficiary. Since finance is always innovating, there are many more loans that one could borrow or lines of credit one could access, but so check with your financial institute or a financial professional to find out what works for you.